Hello everyone and welcome to another short video courtesy of investingsuccess.ca. Today is the 26th of December 2023. Here's Chairman Jerome Powell and a little cartoon graphic of a ballerina dancer twirling around. And this is an appropriate image, I guess, to have on this slide because at the FOMC meeting recently in December, Mr. Powell did something similar to the ballerina. He did a complete pirouette. He did a complete unexpected about face. He insinuated that in 2024 there could and most certainly will be interest rate cuts. This is what the players on Wall Street have been banging the table on for the past several months, and they've been trying to put almost words in his mouth and get him to say that he was going to cut interest rates. Well, he finally said it, and it sort of took everybody by surprise. We've gone from inflation is sticky, we've gone from interest rates are going to be higher for longer, to all of a sudden cutting in 2024. So what exactly is going on? What does he know that the rest of us perhaps don't know? Well, the one thing that I have been looking at is the reverse repo market. And that is a facility that the Federal Reserve runs through the Federal Reserve Bank of New York, in which a financial institution, or perhaps even something like a mutual fund, can take cash and they can park it in this overnight repo market, and they can earn a percentage interest on the cash that they parked for a specified period of time. Now, this overall repo market got up to, earlier this year, something in the neighborhood of almost $2.3 trillion. It had grown at a pretty healthy clip. But now, for the past 6 months, the Fed has been very slowly winding it down, not allowing as much money to come into it. And so institutions and mutual funds looking to earn a return on surplus cash have instead been purchasing short-term, almost 1 month treasury bills from the US government. So why is this important? Well, what Mr. Powell has basically done is he is closing the door on the overnight repo market, and he's telling people, don't look here, nothing to see here. Go and talk to Janet Yellen at the Treasury and park your money with her, because she needs the money to finance the budget deficits and to avoid government shutdowns in the United States. So as the repo market is declining and sloping down, if I were to show you a chart of the general bank account of the US Treasury, you would see that money is flowing in there, and that this is all by design. The US government is going to be talking again about a potential shutdown. I think it's third week of January. And so it's critical that Janet Yellen gets money into her general account over at Treasury to kick the can down the road, as it were. So this explains this sudden pirouette, if you will. He does not want money parked in the Fed, and by cutting the Fed overnight lending rates, he is effectively signaling that he is cutting back on his balance sheet, gently closing the door, making it less encouraging for money to get parked at the Fed. Now, all of this ties then into economic indicators. There are leading economic indicators, there are coincident economic indicators. I remember learning about some of this in Economics 101. So, for example, jobless claims, durable goods orders if you go to Home Depot or Lowe's and buy a new refrigerator, that's a durable goods order. Purchasing Managers Index, and the fact that the yield curve in and of itself is still inverted. These are all leading indicators. And if you were to tally up the various leading indicators and express that as a fraction or a ratio of the coincident indicators, what's happening is the leading indicators in the economy are actually getting weaker. And all you have to do every morning, as I do, is watch a little bit of Bloomberg on YouTube, the early morning show with Tom Keene and Lisa Abramowitz. They'll tell you that companies are laying off people. They'll tell you that the consumer is weakening, and some of the guests that they bring on to their early morning segments will echo those very same sentiments. So it is not surprising then to see this plot of leading to coincident economic indicators sloping down. And by the way, this chart is courtesy of Yardini Research, Ed Yardini and his fabulous group of researchers. So here's the downslope. And if you look at this chart, every time this ratio has declined, what has happened? You've hit some kind of a recession. And I think we're going to hit another one again. The question this time is, how severe is it going to be? Is it going to be a hard, disastrous landing, or is it going to be a soft landing? Well, I think the U.S. economy is generally still robust enough that any sort of a landing is going to be still a bit painful, but it's not going to be a disaster. So get ready for that early in 2024. And as some of the people coming on to Bloomberg have suggested, it might not be a carte blanche soft landing. It could be various sectors of the economy that feel pain more so than others. Now, speaking of rolling soft landings or rolling landings, certain sectors feeling more pain than others. Here's some interesting trivia to look at. There's something called the debt wall, and it is very much present now in commercial real estate. What's happening is there's a lot of commercial real estate debt, and this money has been borrowed from banks, pension funds, insurance companies. And a lot of it is going to be coming due before the end of 2025, and it will be in need of financing. So here's another hint as to why Mr. Powell may have done his little pirouette, his about face. He knows that there's this debt wall looming out there. And a lot of these office, retail, industrial, multifamily dwelling type properties, they've lost value. They've taken a haircut and they're underwater. There's a large real estate firm called Colliers International, and they're actually reporting that almost all of the big office towers in Los Angeles are underwater on their loans, meaning that they're in trouble. So on average, Colliers is suggesting that the office towers in Los Angeles have something like $230 in debt per square foot. And if you're looking for a metric to make sense of that, there recently was a building that sold at $154 a square foot in Los Angeles. That's a haircut. That's underwater. There's a Canadian company called Brookfield Property Management. They recently literally took the keys to a large office building in Los Angeles and walked into their banker and just dropped the keys off and said, "It's yours. See you later." So there's a problem in commercial real estate. And this sector in particular, I think, is going to really take it on the chin. And I've got an image here of a smoking gun. So yeah, that where there's smoke, there's fire. And I think this whole commercial real estate thing is the smoking gun right now. And I think that's what potentially has got the Fed a little bit rattled. And that then is going to spill over, I think, into the regional banking sector. And here is a chart I want to share with you. The early in 2023, in response to the outright failure of things like Republic Bank, First Silicon Valley Bank, the Federal Reserve, in concert with the U.S. Treasury, created something called the Bank Term Funding Program, the BTFP. And they basically put together a slush fund of money to make sure that other regional banks did not fail. And they said that they would run this program until March of 2024. So it was basically a 1-year stopgap measure. Well, as you can see in this chart, almost immediately there was a huge demand for some of these funds. But then the regional banks generally got it together, and yeah, there was an increasing demand for money from this fund, but it slowed down. But now here's what various economic commentators are talking about. If this thing is due to end in March of 2024, like literally in 3 months, how come it's still growing? How come regional banks are still demanding money from it? What's going on? Well, this all ties back to your commercial real estate. And there are some regional banks that are heavily exposed to commercial real estate, which is underwater. There is going to be some regional banking crises, and it is going to send a shiver through the markets, and this is going to start happening here pretty quick. However, it's not going to crash the markets, as a lot of people on YouTube are insinuating, but it is going to send a little bit of a shiver through the markets, and the U.S. Treasury and the Fed will be forced to react, and they will be forced to step in once again and help out. And I'm going to explain to you here very shortly why I don't think this is going to crash the markets. And here's why I say that. I follow the 18.6-year cycle of the North Node. So here's the node, and it's currently at 21 degrees of Aries, as you can see. Now, the planets in the zodiac wheel, they travel this way. The node goes opposite. And so, according to Louise McWhorter in her 1937 book, Market Forecasting, when the North Node gets into the sign of Aquarius, you've got a serious problem. So Aquarius is over here. It's going to take the node pretty much about a year to get into the sign of Pisces, and then another year to get into the sign of Aquarius. So we've got a couple years ahead of us before we are poised for the next nasty financial crisis. So if you think 2007, 2008 was bad, yeah, it was. That was the end. That was the node in Aquarius. So you've been through it. You know what it felt like. And I think the next one is going to be even more painful, but we've still got a couple years before we get there. Now, the other thing that McWhorter talks about is the planet Jupiter. And you can see here that it is currently at 5 degrees of Taurus. McWhorter says that when Jupiter gets down into the sign of Gemini, no matter where you are in the 18.6-year cycle, Jupiter coming into Gemini and passing through Gemini is generally a good thing for the economy. So, yes, we have commercial real estate problems. Yes, the Fed is aware of that. Yes, the Fed is trying to steer money towards the US Treasury to help them avoid government shutdowns and to finance their debt. Yes, 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 I get all of that. But the markets are not ready for an all out crash just yet. Jupiter says so. McWhorter says so. So I think 2024 is going to be a volatile year, which is good. I love volatility because I'm a trader and I look for periods of panic in the media, markets coming down, the favorite stocks that I like to trade coming down, and then I use astrology of those individual stocks and chart technical indicators, and I look then for an opportunity to buy the dip, and then I look for an opportunity to sell the rally that follows. So I think 2024, thanks to Jupiter, and just thanks to where we are in the overall cycle, I think it's going to be a fairly decent year. Now, on net on average, for the major indices like the S&P 500, I'm actually predicting that for 2024, we're probably going to have overall single digit returns. Now, that could be an overall 2% gain, it could be a 9% gain. I don't think we're going to get into the double digits, but I am looking for the volatility. That's what I want. That's what I crave. That's how money is made. Buy the dip, sell the rally. So, where are we on the S&P 500? Well, we reached a peak in January of 2022. And 2022 was a nasty year, and we actually bottomed in October of 2022. And interestingly enough, 2022 was the end of the latter part of a Shemitah year. And if you've read my almanac, I explain what Shemitah is. So the fact that we bottomed in October, not a big surprise. And since then, the market rallied, had a little pullback, but look at what we've done lately. We've almost gone vertical. Now, it's important to note that we are here. We have tested, we have recovered, retraced 100% of what we gave up in 2022. So from here, if we are going to have some angst concerning commercial real estate, if we're going to have a little bit of angst concerning regional banks, if we're going to have some angst concerning government shutdown, government debt, government budgetary concerns, fair enough, bring it on. Because if the S&P declines, Fibonacci 38%, that'll take us down to 4,500. If it goes Fibonacci 61.8%, that'll take you down to 4,300, which oddly enough is right at the 200-day moving average. And so I would not be shocked to see up to a 61.8% retracement of the rally that started in November of this year. That would be normal, that would be healthy, that would all be in alignment with Fibonacci mathematics. And from there, buy the dip, sell into the rally that follows. And I think that is what is going to characterize the entirety of 2024. Buy the dip, sell the rally, take advantage of the volatility, because we're not ready, we're not at that part of the 18.6-year cycle where we are set for a full-blown crisis. That comes a couple of years from now. So take advantage of it all. And that's it for me. Finally got the 2024 Almanac out. My formatter, who gets it ready for publication, had a little go around with COVID, and so she was running behind schedule. And my publisher was running behind schedule with other commitments, but it is out in both paperback and ebook format. So you can go to Amazon, order it in paperback format, Amazon Kindle in ebook format. It's also available through a book publisher in the United States. And so if you are in either Canada or the US and you go to your favorite book store, yes, they will be able to order it in for you. But hey, let's face it, Jeff Bezos probably needs a bit more money for some rocket fuel in 2024, so it's probably quicker just to get it from Amazon and give Mr. Bezos his fair share of earnings on the book. You'll find me again at investingsuccess.ca. I've got my astrology letter, my cycles report. You'll also find me on Substack. I've got a couple of courses on Udemy. Looking for more course content. I got to come up with some ideas for some new material that I want to get onto Udemy. And always, always, always remember to follow the trend. The chart technical indicators, as boring as they might look, are extraordinarily powerful. And when you combine them with astrology, either for an overall index or an individual stock, and when you identify times when an individual stock or an index has sold off, and if you can identify the turning point using one of these chart indicators, and if that happens to align with a significant astrology type indicator, then you're in business. There's your opportunity to buy the dip and then sell into strength in the rally that follows. All right, guys, thank you kindly for listening, and thank you for viewing my various posts during 2023. I will keep these coming to the best of my ability in 2024. And if you ever have any questions, you know where to find me. You can get my email at investingsuccess.ca. And we will be in touch, and let's hope that 2024 is a moneymaker for all concerned. Talk to you soon. Thanks.